session. I want to do a quick summary, not really a quick summary, but a summary on the One Beautiful Bill Act, OBA as it's known, signed into law July 4th. Key points: we got some tax reforms, healthcare and social program changes, immigration and border policy, energy, defense and national security, education, budget and debt. Positively and negatively affected millions and millions of Americans. You could argue for better, for worse. Positively affected high income earners and businesses, middle class taxpayers, residents of high tax states. Parents are gaining access to Trump accounts. Oil and gas industry, defense sectors, credit unions. Negatively affected would be low income individuals and families, vulnerable groups, hospitals and healthcare providers, rural communities, undocumented immigrants, asylum seekers, environmental clean energy sectors, states with AI regulations. So I've got a summary. If you'd like it, I can post it in the blog section of my Discord. Just leave me a comment. So it's Chris Pulver Trading. I'll post that there in my blog. So this would be the One Big Beautiful Bill Act summary. All right, I'll post that right here. See if that actually works. Yep. It's not as clean as I wanted. Hang on a second. I'm going to dump that. Okay, we're good. All right, let's get into the markets. Really, things are pretty quiet today. P&L's up, which is good. Fine. Price action today, extremely quiet after a little bit of sell-off yesterday. No major news today. We had a surprise pause from the Reserve Bank of Australia. Currency strength-wise today, Aussie still on top after that surprise, stayed there all day. Swiss also starting to gain a little bit of strength. Japanese yen the weakest. Go into your indexes. Tape-wise today, very, very flat. Here is intraday price action. We started right here around 62.30. We are still here at 62.25. I'm looking to see how the day finishes. Ended up taking for my daily profit play members, we did a standard daily profit play strategy, paid out pretty nicely. Ended up grabbing, what was our profit there? About 50+% profit on that, or close to it, I think. Let's do about a 43% winner. And then the other one was I think I lost 10 cents on it. So through this little spike to the upside, it was break even or better, and ended up closing out as we came back inside the range. Got out for a small loss, so net on the day was like 55 bucks minus 10, so like $45 on the day was the net. The day isn't done if you're still in strategy number 2, looking for price to get either above 62.35 or below 62.15. Right now, you are probably wanting to cheer on the move to the downside since we are closest to that. So do we get below 62.15 or do we get back above 62.35? Watching to see how this plays out in the next 50 minutes. So it is impressively quiet today for a Tuesday, especially after a sell-off yesterday. You know, looking at the last couple of weeks here, we have been, up for a couple of big weeks. This is the ceasefire agreement. The market ripped pretty aggressively after hitting some lows. I guess I can get rid of some of these. These are from Daily Profit Play. There's our ceasefire agreement prices, grinding higher, melting up higher. To me, this is kind of that fifth wave move that I think is going to roll over and have some type of pullback. I did see an article today. I didn't have a chance to read it, but let me see. Give me a second. Okay, let me take a look here. So seeking alpha. Seeking alpha, one big beautiful default. Tariff tensions rise. I could have swore there was something along the lines of 5 reasons why the market's poised for a July sell-off. I'm not seeing that here. See if I can find it. Yep. 5 reasons the market's ripe for a July sell-off. Let's see if I can get this for free. Hey, I got a free article from Seeking Alpha. All right, let's take a look. Equity valuations forging new all-time highs. Markets continue to price in lofty expectations in growth stocks amidst secular AI demand. $3.4 trillion tax and spending bill poised to raise fiscal deficits as much as $3.3 trillion over the next 10 years. Implication on treasury yields, which are up, by the way. I really think they're up on this tax bill passing. Upend dynamics underpinning key macro trade strategies. Disruptions, equity valuations. Market is yet to de-risk. That's really what this year was so far. That little like de-escalation, de-risk. We saw that a lot in 2022. That was essentially the entire market in 2022 was a de-risking, de-leveraging. Hard set July 9th tariff deadline, which just got pushed out to August 1st, with imminent disruptions to existing corporate cost structures not yet priced into all-time evaluations. Little margin for error. VIX also showing resilience at elevated levels. Incrementally cautious, looming correction. Well, that's pretty much welcome to 2025. Cautious, cautious, cautious. Let's see here. We've got the July 9th deadline that's been pushed. Earnings will be key. I mean, we have inflation data next week. Earnings will be key for these next probably 30 to 60 days. MP says, understand the collar trade stock goes up, no brainer. My questions around expiry if stock goes down to your long put strike, say 5 cents above at expiry. Do you want to talk numbers again? You have an example? We can use, I think we did an example on Intel. I use collar trades on Tesla. I use collar trades on MicroStrategy. I'm using collar trades on the SPY and the Qs. Here, I'll show you. I've got an example here. This is a new account that opened up with me last week or so. Here's a position on the Qs. So here's a collar trade in the Qs. I bought the shares around 529. They're trading at 552. But I also added in a collar trade for $9.20. So my break-even price is around 520. My call away level is 536. My put at $500 is basically worthless. I mean, it's not totally worthless, but this is August 29th, so I still have 52 days. If we see a 3% correction, 5% correction, maybe 7 to 10% correction, especially in the NASDAQ, even though this is out of the money, I might still be able to see this collar act as a break even or better. We do the numbers on it. I mean, basically, here's how the math would work on a collar trade for that particular setup. I'll give you the notepad so we can see the numbers. Let's go QQQ collar trade. So I buy 100 shares at 529. I sell what's the expiration there? August what? No, don't move that. No, don't move that. The August 29th. Sell 829 expiration, 536 call, and I buy 829 expiration, 500 put, collected $9.20 credit. So break even on shares, or I should say break even position, is going to be 519.80. So 529 minus the 920. Right? So I buy the shares at 529.89 minus my 9.19. Own shares at 520.70. Okay. So 520.70. Okay. So as of now, QQQ is 552. So what does that mean? If I do nothing, my collar trade has the shares called away at 536. Okay, which is going to give me roughly total profit will be 536 is my call away level minus the 520.70. I'll make $1,530. Okay, so that's my profit. Let's say if QQQ falls, let's say we fall 5%. So go from 552, let's go to the Qs here. Let's say we go 5% from the recent highs. Depends on the speed here, because if it's falling fast, that's one thing. But because my put is 500, this is an out of the money put. So if this price falls, I mean, to get to 500, this would have to be about a 10% correction. That's actually why I put the $500 put there, because it was cheap enough and it's 10% of the money. That I thought, hey, if we have a 10% correction, going from roughly like a 10 delta to a 50 delta is going to pay a big difference. Okay, depending on expiration, because if this happens, let's say in the next 2 or 3 weeks, this pays really well. So the put protection pays pretty well. If this happens like the week of expiration, my put is only going to be worth basically anything below $500, because that's the at the money strike. Okay, so let's just say that we fall. I'll put kind of two scenarios here. QQQ falls let's split 10% and reaches 500 price. My 500 put, if time value remains, will potentially show profit. Okay. My 500 put, if little to no time value remains, will show no profit. Okay. But my break even remains 520.70. So my next action is likely to, one, add a new collar position with the new break-even price. Okay, which means I would probably do sell the 525 call and maybe buy, I don't know, like a 490 put. Or I can basically finance one where it's like I'll sell a call, sell a put, or sorry, sell a call, buy a put, have it cost me nothing, but my sell strike is 525. And if we have any downward pressure, then I just protect my downside. So the easy one would be if I just add a new collar position. Let's say I can sell the 525, or I'll say I sell 530 call, and then buy another 500 put for net credit. Okay, so that net credit would be subtracted from the 520.70. The other option is I add a covered call above my break even and keep the credit. If price is all the way down to $500 and I sell a 520, like I basically sell for my break even, I just sell a 520 call, but I can pull in $5 or $10 extra dollars. It just lowers my cost basis. Okay, so example would be sell a 520 call for $10 credit. Now my break even is 510, 510.70. And if price is at 500, the question is, do we get to 500 and bounce back up? If so, do I get it called away at 520, make another $1,000 on the trade? Like it's fine. And I can keep rolling and rolling and rolling. So initially the point of my collar trade is I want to have protection if it's needed. I'll continue to add protection if I feel that it's needed. If we have a dip, if the market is going to dip and I can cash in on my put side, I don't necessarily want to keep adding collar trades after we have a nice correction. What I'd like to do is, if we have a correction, it can close out some profit on my put side. What I'd like to do is then just focus on either one, owning the shares of the underlying asset cheaper and letting price go up on its own, where I can just run with that gain, or two, I try to sell out of the money covered calls. So if we're all the way down to 500 and then price starts to rally back up, well, if I sell a 530 covered call, a 535, see what I'm saying? Like I just want to sell something above my break even, so I still keep credit. Okay, and I probably get more short term. Like I could do zero DT. I could do 1 week out expirations. I just try to chip away at my price. And, again, I don't really want to lose the shares. I'd like to, if we go down to 500, what's the recent high in the Qs? 560? 557. I mean, if we drop to $500, okay, I'm going to try to own shares back into, 540, back into 550, back into all-time highs again. If that is a ventilate, like just a cleanse, like let the market cleanse, let the market purge. Don't turn bearish. It's like I don't think we really have like a full-on bear market. But if you're uncertain, then you just keep the downside protection with collar trades, right? We talked about this before. The collar trade, remember, is to help offer some protection while also letting the price still appreciate. That makes sense? Because right now, when I put on this trade originally, my break even's 520 and I get it called away at 536. So I'm going to make around $1,600 on the trade if price stays exactly where it is right now. But what I'm going to do is by the time we get into this 829 expiration, if price is still well above 536, I'm just going to keep rolling this call. And I don't need the put anymore, or I don't want to necessarily add the put anymore. Or if I do, it's going to be further out of the money or a debit spread that costs me way less. Right. So I still want to try to lower my cost basis, maybe get an extra $2, $3 every time I add another component to this. Or if I just sell covered calls, try to get another $3, $4, $5 and do this for like every 1 or 2 weeks. So ideally, if I can take my break even by just selling options against my own positions and lower my cost basis to 515, lower my cost basis to 510, lower my cost basis to 505 or $500, I can look at this as a profit target and say, well, if we go back from $500 all the way back up to 550, that's a good gain. I'd be happy with that, right? And the trick, of course, is do I just sell covered calls the whole time, which you can, okay, or do you try to time it where now I have shares low enough that I'm just going to let the price run with no coverage? I'm usually the type of trader where it's like I'm just going to take covered calls, and if price goes faster than my covered call, I'll just roll it. It's okay. Like I know I'm capping my upside a little bit, but I'll keep rolling it. I'll keep generating income, and it adds up. I mean, case in point, I'm doing it on IWM. I went from a $200 break even to now below 190. The SPY, I went from a 590 break even down to 565. MicroStrategy, I went from a break even of $400 down to like 320. Tesla break even at 275 down to 240. So, and I can still sell calls, and I'm still like those are in the money covered calls, and I'll just keep rolling them until I'm kind of done. Until I'm like, all right, look, I'm happy with this. Maybe cashing in some profits by the end of the year, then starting some fresh positions in 2026. So I'm kind of looking at these are campaign trades, right? Where as long as here's the important thing with the collar trade, I want to own the shares. Like if I have a collar trade, it's because I have owned shares. This isn't something like I'm not going to, sell a call, buy a put just naked. That doesn't do me any good. This is around the own position. Okay. So it's just the simple math of if I buy the shares and I can create a credit situation on the collar, it helps me lower my cost basis. Okay. If you want to finance protection, if you want free protection in the market, here's a good way to do it. I buy the shares of the Qs. Okay. Let's say we want to go out and we're really uncertain until, maybe the end of August. We're worried about the end of August. Okay. So let's go to the end of August or even into September's expiration here, 73 days out. Well, if I sell a 555 and I buy a 550, look, I can still get $3.70 credit. So that lowers my cost basis. Okay. But if price drops, I'm essentially trading an at the money put, which will protect me most of the way down. If we drop from 550 down to 500, we're going to get $50 of actual value in this put option. So let's say it trades for $50. Well, I only paid $15 for it. So I get $35 of profit. That helps me lower my cost basis. So, that's kind of free. If I did it at the money here, if I do a 550 call and a 550 put, okay, again, this could be served as a collar trade. I'm getting $6.94 for it. I have all the protection and I'm still getting credit on the call side. So, the reason I like to go a little bit higher is like right here, for example, I can get some price appreciation where I can still get $1 credit, still have an at the money put for protection, and I lower my cost basis and still give myself upside potential. Make sense? All right. So let me get some comments and questions there. Does that make sense, MP? All right. Learning so much. Good. Okay. Thinking of doing collar on TLT. Good time to buy. The premiums do suck. They really do. Yeah, no, I get it. Yeah, let's talk about it. So, I mean, big difference in price because TLT is like $84 or something like that, right? We're trading at 85, 86. So let's talk about it. So I have a diagonal spread running on TLT. It's not a bad spot. Like if you own the shares of TLT, you're essentially getting about a 4% dividend right now with the current treasury yields. And it should be more than that, but TLT showing like 3.9, which is kind of lame. I mean, the 10-year note's up to like 4.2, 4.3. It's kind of lame that you can't get that out of TLT right now. But I think the most important thing for 2025 is that the bond market remains stable. It might be boring, but it's probably going to be stable after the pivot on April 9th. So if I were to buy shares of TLT, okay, if I were to buy shares, like from scratch, I'm going to buy shares like right now as an example. Let's go to some of the drama of like, okay, look, the next 60 days, I think the market should pull back X amount. Well, if the S&P pulls back and the NASDAQ pulls back and the bond market catches a bid, then TLT probably goes up a little bit. But it's really, okay, if I bought shares right now at 85, 84, so let's illustrate this here. So I'm gonna put like a line here just to separate. So this is just a Q's example. Okay, and we'll talk new trade, TLT hypothetical, right? So current price is 85.84. Let's see what a collar looks like for income. Okay, this isn't a trade I would say is good for like big, huge potential. Okay, this is a safe, stable. I want downside protection in case the bond market croaks, but I want upside or a couple dollars upside to get some income. And then you kind of maybe within 30 days, right? Like I don't want to go out super far, but I'd say within about 30 days, can we generate some income? Let's find out. Okay, so if I buy shares, let's say I buy shares at 85, 84. Okay, so again, this is an example. I'm not doing this trade. We're just going to talk through this, but example is I buy 100 shares at 85.84. Okay, now I want to pair the options with it. Let's look at a collar trade. Let's go out around 38 days, which is the August 15th expiration. Okay, so if I buy the shares at 85.84 and I sell an 86, okay, or I sell an 87 and get $1, I can buy the 84 and I can get 31 cents credit. Now, how's the math work on this? I've got a little bit of price appreciation to the upside, and I have some put protection if things go down. What's the low we saw in TLT? Okay, the lows we saw in TLT were down here towards 83.35. Okay, do we need that downside protection? I don't know. Maybe. Because lower than that, we were down to 82. Before that, I mean, we have seen this instrument has been lower. It's been a long time, but we've been lower back here in 03. This is crazy, right? We're down to like 02, 03 levels back into the 80s. Is TLT a good buy and hold at these levels? I would hope so. I just don't know if the market has to break first. You know, it's like I'm just going to say similar to like a flash crash we see sometimes in the Forex market. You know, maybe this market snaps these lows and then snaps back and puts in like a multi-month or multi-year bottom. Okay. So I don't think it's a bad trade to just buy the shares with the intention of like, look, we'd be trading near, 20-year lows. However, if I bought the shares right now at $85, I'd want to have that $5 protection just in case. Okay. So if I did a collar like so, I sell the 87 and I buy the 84. So I'm covered at 87. I'm protected at 84. I get 33 cents on the trade. Okay. So if I buy the shares at 85.84 and then I add the 8/15 expiration collar where I sell the 87 call and I buy the 84 put, I collect 33 cents credit on the trade. My new break even would be 85.51. Okay, so if TLT is greater than 87 by expiration, it's called away for a net profit of $1.49 per share. If TLT is, let's say, less than 84 by expiration, is the put is the long put, which if I did that long put, the debit on that trade is going to be about 73 to 74 cents. Let's put 74 cents. Is the long put showing profit? Okay, so if yes, I can close for profit and lower net break even. And then repeat, right? I can do another cover call, add another 30-day put option. I can just go 30 days out, sell a call, buy a put, repeat, try to grab another 30, 40 cents maybe, lower my cost basis. Okay? And if you're comfortable doing that, where it's like maybe I want to take TLT down to close to $80, close to $80, close to $79, where it's sitting at 20 plus your lows, and you'd like to think that maybe it's a good buy trade there. Maybe. I just don't know. It's like, does the bond market break? I don't think so. I mean, if the bond market breaks, I feel like we have much bigger problems in the financial markets than we do just like, oh man, the US bond market's crazy. I feel like it has all sorts of consequences. So it doesn't mean I want to buy the bond market. I don't like bonds at all. I think gold and silver are better. I think gold, silver, Bitcoin is better. I think commodities are better. I think there's better places to park cash than US bonds right now. But it's a trade. So if it gets called away, I make $1.49. So on that investment, I can make $1.49, which is $149. Okay, out of a roughly, see, my break even would be 85. So out of 85.51. If it's a pure cash trade, I'm making about 1.7% in 30 days. So here's my question. If I do this every 30 days, okay, so 1.7, okay, so 1.7 times 12. On this position, as it is right here, I could essentially generate a 20% return on TLT over a 12-month window if this is how I traded it. So rather than buying shares of TLT and holding to get a whopping 3.8% dividend on that ownership, I could actually flip this over and over again every 30 days, do a collar, try to grab a couple of cents here and there, or get it called away, repeat the process. But you could probably turn closer to like a 20% return on that investment, right? So let's look at the difference. If I took $8,500, it'd be 85.51, okay, times 0.20. I could, over the course of 12 months, doing this same process here, I can make roughly $1,700 on that trade. If it gets called away after, lowering my cost basis every 30 days, about 30 to 33 cents, that's roughly what I make in that investment. Well, if I make 1710, okay, 1710 out of 85.51 pays a lot more than if I just bought shares at 85.84, okay, and I sit on the dividend, which would take 12 months to get. It'd be quarterly dividends or quarterly, most likely quarterly add-ins. So, but let's just go out for the full year. Our dividend is 3.88, so 0.0388. So I make like $330, right? So if I do 85.50, well, 85.84, if I don't do any option trading here, times 100, that's my dividend. I'd make $333 over 12 months if all I did was buy and hold. Well, if I buy and hold TLT and the stock price goes down or the asset price goes down, I'm still sitting in a drawdown. This is what's happened to so many bond traders for the last 4 or 5 years. They have seen nothing but this little yield and drawdowns that is essentially neutral. You have a drawdown in price, you get your little 2, 3, 4% yield. It's a wash because the price is still going lower. If you add options to it, at least you have downside protection. It's there if you need it. You can, let's say we drop down to $80. Well, my 74-cent debit could be trading for $4. Well, that lowers my cost basis down from 85.51 all the way down to 81. That's a lot better position to ride any type of downward pressure on the bond market, ride it lower, and then try to position for some upside. The hardest part with a collar trade is if the stock is going up or the underlying asset's going up, you're going to cap your gains. Okay. But once your price is higher than your covered call, then just think of it as I'll just keep rolling. I'll just keep rolling. I'll just keep rolling. And you can do that as long as you want and still make income on that rolled covered call by just going out in time and time and time. Okay. Paying for, right here it says dividend yield 3.88. So I'm not sure where you're getting 4.6. I mean, it should be paying somewhere between like the 10 and 20 mix, which should be over 4%. Even at that rate, though, 4% is not going to make you as much as what I talked about doing in a collar trade. If you have a collar trade generating 33 cents, look, 33 cents, 33 cents, okay, which is $33 on 100 shares, and you do this 12 times, you just lower your cost basis by $4 whole dollars, okay? And if it gets called away with some appreciation, so you lower your cost base by $4, you give yourself $2 or $3 more of upside, over and over and over again, you can turn this into, $1,000+ which is way better than making $300 to $400 and just owning and sitting and doing nothing. So this is why I try to explain to traders, like, understanding some basic option trades, understanding some basic options on lowering your cost basis, protecting yourself. More importantly is protecting yourself. If this market is just crazy uncertain, nobody knows what's going to happen, you will sleep like a baby having some downside protection, whether it's in the actual underlying stock or asset, or it's in the futures market as a portfolio hedge. I mean, yes, hedges are annoying when they don't pay you, but believe me, it's a lot easier to watch this market melt up than it is watching this market drop 10, 15, 20% in a month. Okay. Everything changes when the market's down. Everything changes when the VIX is up to 30, 40, 50, 60, as we saw this year. Tell me who had fun trading in March and April this year. Like, look, I was like selling premium courageously, but still not certain about the trades. It's like you're really uncomfortable doing what you know is probably the best thing to do, which is take some positions. Uh, the VIX is always like a mean reverting instrument, but you just never know. And the bid askers are super wide. Fills are pretty crappy. Trades are getting blown out of the water with these 3-4% gaps higher and lower. It's all over the place. So it doesn't make trading a lot of fun. Yes, there's great opportunity. There's tons of opportunity when the VIX is crazy high, but that's also the benefit of having cash on the sidelines. The hard part is if you're fully invested all the time with zero protection or zero hedges, you get into a lot of trouble. You know, so and I don't like having this much cash on the sidelines. I've got over 50% cash on the sidelines, and I hate it. Okay, but it's necessary because I think we're going to have better opportunities ahead. I really do. I think we'll have dips to buy. I think we'll have dips to position for. I think we'll have another flip up in volatility, maybe get into the 20s again, maybe 20s or maybe 30s again. But I don't know. I mean, we'll find out. You know. So I mean, maybe I just benefit from a bunch of income trades and some simple systematic mechanical trades that it's like, okay, I put this on, 15 accounts and I generate $100 and I make $1,500 and I do this on 50 trades. Well, I can make some money that way, you know. But if I have any good opportunities, like I'd like to see a pullback in GLD or pullback in gold or pullback in SPY or Qs or Dow or Russell or anything like that, well, I'd jump all over those trades and try to position for number one, good income, a little bit higher premium, much better discount prices, and maybe even dollar cost averaging in, where I think we can get back to these highs that we've seen so far this year. Okay, let me see if I can find me a S&P seasonality chart showing the okay. Month-to-month performance. Okay, we'll go through all the data here. Let's see, January historically weak, average return of around 0.7 to 1%. The January effect suggests prices rise due to year-end tax planning. Okay, February, one of the weaker months, average return is usually negative 0.1 to 0.3. March is moderately bullish, average return of 1.2. This March obviously was pretty bad. April, one of the strongest months. Even though we had a nasty, nasty drawdown in April, it was one of the more reflexive months, which finishes positive, 1.52% historically. May is mixed, anywhere between 0.1 to 0.5%. Sell and may go away. We've shown that data doesn't really add up. I like the idea of sell and may go away, as in wait until the end of May. Some have said the old adage is sell them, may go away, like literally May 1st you sell them. Like that's a terrible strategy. I'd much rather sell June 1 if I'm going to sell anything, or don't and just have protection, because we've seen a lot of times April, May melt ups get us into a June and July continuation with like there's just less, less selling, less resistance, and through the summer months the market just continues to drift. June historically weak. July, one of the best months, average return of 1.4%. That's over 35 years. August typically bearish with a negative return, 0.2 to 0.5 negative. September, the weakest month with an average loss of 1 to 1.2%. October, usually strong, 1 to 1.5. November, one of the best months, average return 1.5 to 2. And December, historically strong. Santa Claus rally, usually that December rally that comes from like Christmas time to New Year's is a Santa rally. It hasn't showed up the last couple of years though, but we've also had 20+% gains to show for it. So anyway, as we know, it's like you go back 20, 30, 40, 50 years, like most of the time the market tries to find a way to go up. So, but as I said, protection is the key. Risk management is the key. Okay. Dean, there you go, man. Got your $100. Very good. Do the collar and earn the dividends. Yeah, but what do you have to do for that, MP? To earn the dividends, you got to make sure your sell call is above current price. You want to make sure that your sell call is always higher than the current price, because if you have a sell call in the money, you're potentially not going to get that dividend. Right? You own the shares, but you're going to have a negative call value, and you might end up basically eating the dividend versus getting it. So just be careful. And like I said, TLT just doesn't offer a ton of premium. Like getting $1 premium, it's like, okay, I get 72 cents. That's fine. I mean, this is essentially a free hedge. If I did a little bit more in the money, I get 44 cents, but now I don't get a dividend. If we're above $86, like I don't get a dividend. Like I pay that dividend. So that can be tricky, and you don't get a lot of premium to go up multiple dollars in price appreciation to kind of stay out of the way. Now you can go out further in time, but the idea here is, going out roughly every 30 to 45 days and trying to, pick your 30, 40, 50 cent credits on the collar. And if you're looking at the technicals, the collar to me is, if we breach these lows, I think that there is a buying opportunity. Okay. In fact, it wouldn't surprise me is if we see, and this is a crazy if, but if we see global yields rising, okay, do we see global yields rising that have to break something? Do the global yields rising break the market and therefore give the bond market a big dump and flush, and then the bond market is so cheap that it's like a no-brainer buy? Maybe this is within the next like 1 or 2 years. I mean, if you, and I don't think we're going to have like a flash crash move, but we kind of did this year with like little basis trade blow up. But if we were at what is basically all-time lows on TLT, it's hard not to think that at 4% yields or 5% yields that this can't be a better like risk-free investment versus all the potential risk that comes with like a drawdown in the equities market. Although I wouldn't be thrilled if my return was 5% a year. Risk-free is one thing, but the cost of living, loss of purchasing power, currency debasement, like all these things add up where it's like the average investor probably needs to be making closer to 6 or 8% a year just to break even. So the S&P as a whole right now is basically your means to stay break even without losing purchasing power and falling behind. Fortunately, there are other assets that are outperforming the S&P. That comes the discussion of having gold in the portfolio, having silver in the portfolio, having non-correlated assets in the portfolio, having Bitcoin perhaps in the portfolio, right? All right. I wanted to take a look here at Ethereum. I thought about actually purchasing some EETH, which is an ETF at 47. This is another one I could purchase kind of on the cheap. If we do make a run up, I mean, there's 40+% if we get a run. That's a 58% return. If we get to these highs on ETHA, let me see what the expense ratio is. Discount premium, okay. Higher beta. I mean, there's risk here, but if I put in, let's say $2,000 and it goes up, and another $2,000 here and it goes up. Let me see if I have an options chain on ETHA, because if I do, at least I can sell covered calls and kind of take some profits or at least lower the cost base a little bit. So ETHA, I have some options. They're not great. Price is at 20 bucks. Let me see I can sell a put at $11. So let's see here. If I did let me see if I can stack some puts. This is cheap enough that maybe like a 13, like 14, 13, 12, 11. Let me see if this would actually be worth paying. So if I did 14, 13, 12, 11, all puts, I get $270. Cost me about $4,700 in cash. Okay, like I can do this on all my accounts. I could take 400 shares. It wouldn't be breaking the bank. I'd basically allocate about $5,000 to this position. If nothing happens, I make 272 bucks. Okay, if I were to buy the shares at 1976, I can buy shares here at 1976. They go up around 58%. So I can turn around a 2K investment into roughly $1,000 profit. Like to me, that almost it seems more cost effective just to buy 100 shares and then buy 100 shares and see if this goes up. Because I'm going to allocate $4,700 in cash for puts, I might as well just buy the shares and buy the shares. Buying 200 shares versus being on the hook for 400 shares if I get assigned. I'm just debating on which one I like better. There's a little bit more price history here on ETHA, Pro shares versus iShares. I mean, again, pretty popular ETF deliverables. Let me see. Let me look at ETHA. See if there's a Morningstar summary on this. And also make sure that this is trading a lot like the spot price. Track the spot price of Ether, less expenses, liabilities, provide accessibility. Okay. Cold storage, safeguarding method, holdings of value daily. Okay. What's the expense ratio on this one? Okay. And this one, so ETHA is actually trading at a slight discount. I'm going to take this trade. I'm going to buy 100 shares. I'm gonna buy 100 shares here, and I'll buy another 100 shares here. If I get filled on both, then my break even is going to be around $15, and I will sell covered calls and get out of the trade. At the money, an at the money covered call is offering about $3 to $4, so that's good. If I had to own the shares, I can still get $3 $4 every, well, I guess 164 days. What's it more for like a 45-day window? I still get $1.50 to $2. That's pretty good. That's pretty good. All right, I'm gonna take this trade. So I'm gonna turn this one into a bit of a campaign trade. I don't really want to protect the downside because I think we go up. I don't want to get in the way in case this thing does rip. So if we go higher on Ethereum, I don't want to get in the way of that. Downside protection, maybe, but I'd rather just dollar cost average. So if I buy it here and I put a pending order to buy it here, if price goes up, I take about a $2,000 investment and I generate about $1,000 in gain. Okay, so this is not expensive. I mean, this is cheap enough for me to put this on all accounts. And if I can make 15 grand on this, like cool, I'll put a trade in and hopefully we get a nice little technical move on Ethereum back to highs. So let me see if I can squeeze this in for here. The buy order at the lows would be around $11.50. So 11.50 and then 19.77. All right, so new trade. Let's go long. 1977, 100 shares. Okay, everyone's going to get in on the action. Okay, also this shows like it's trading. I guess I get a little bit of a discount here. So that trade is filled. That trade is filled. Filled. Seven two. 761. Okay, just going to get these in before closing bell, hopefully. This one's good. 5, 2, 3, 4. All right, last couple of counts here. Okay, so buying there, and then I'm going to put in a pending order at 1150. 1150 and get these all pending. This is going to be a pending order for everyone here. 1150 for another 100 shares. Pending order. Pending. Okay, and I've got a few minutes. I should be able to get this all in. Okay, 2. All right. And then final counts. There we go. All right, so I'm add this into the ETHA, all accounts. Buy 100 shares at 19.77. And pending buy at 11.50. Price target. I would say if we make new highs in Ethereum, so if Ethereum would be making a run back up into the 4100 zone, I'm just going to set a chart alarm at 4050. So 4050 is near all-time highs. Well, I guess nearing resistance highs. And the all-time highs are around 4800. So if I want to be a little bit greedy, then I can say, yeah, we get to 4100, we get to 4800, we hit all-time highs in Ethereum. Maybe that's the trade. Okay. But if we get back to this level, I wouldn't mind just taking profit. If we get a run right there, take some profit, it's a good trade. So if I buy here, there's my reward, there's my risk. If I buy at the lows, there's my risk, there's my reward. So I dollar cost average into the halfway point, there's my risk, there's my reward. I don't really want to hang on to this if we're, too much lower. But if I did, I'd own the shares, lower the cost basis, start selling covered calls, and work my way through it. Your calculations are a little off when doing at the money calls. So what do you for what asset? $30 would be a little more premium. For what asset there, MP? mean, if I want to do this without owning the shares, like the nice thing about owning the shares is I don't pay anything for it. There's no commissions, and I've got $1,900 invested into it that can potentially pay me about $1,000. So if I turn, profit here where we hit the highs, let's say we hit over 4,000 on Ethereum, that run is something like 55%. Well, if I make 55% on 1977, I make about $1,100 times all my accounts. So I could turn Ethereum into a little $16,000 winner. It's just a trade. If I, double my position where I buy here and I buy here and I get filled on both and my break even is this point and I take it all the way up, well, let's look at that return. That'd be a return of around, let's say 90%. Okay. So 1977 times the other one's like 1,100, so plus 1,100 times 15. That's how much I'd have invested, plus a 90% return. I mean, that's pretty good. I make about 40 grand. So if we just go up from here, I make about 16. We go get filled on both and we kind of double down, I make over 40 grand. Okay. Like it's just a trade. And hopefully the network effect kind of catches on, and this is good for Ethereum. I still like Bitcoin as a primary play. I'm in a pretty decent amount of Bitcoin between IBIT, FBTC. I still have some BITO, but I'm just trying to yield max that thing, I guess. All right, how are we doing on audio? We still good? Give me a quick wire yes if you can still hear me. All right, so I'm going to add this in. This is going to be I'm going to send this out to a couple of my services. This will be new trade, stocks, options, new trade, ETHA, buy 100 shares at 19.77, pending buy at 11.50. This is a ETF play on Ethereum. For medium and long-term holds, but ETH shows a strong technical play with a bullish pattern and room to run back to recent highs and potentially all-time highs. My profit, my percentage target for price appreciation is 50% or greater. To consider moving trailing stop losses. All right, so if I zoom in, we're good. Yep. Lee says good. Audio good from Dean, Baja, Pete. So MP, hopefully just reset. MP, try to refresh. Okay, so this is the trade going after that high. There's my risk. If I add a second position, it's 1150. Actually, maybe. And position 2 would be over here with the 1150. Okay. All right, this is going to go into my project options edge. Okay, tracked. Just looking at FinJuice, Trump is trolling JP again, telling him to cut rates now. Trump describes inflation as being tiny. I know, man. It's just noise. I mean, look, I'm telling you, the bond market is going to be what truly controls Fed's actions. Trump can talk all he wants. The bond market is made up of the most sophisticated markets in the world. It seems like a terrible market to trade, in all honesty, but it's made up with some brilliant people and some crazy traders out there. And this is the bond market that will, like they say, the government can keep adding to the deficits if the bond market takes away the keys. It's true. If yields go up, there's no way that we can grow our way out of this thing with higher yields. I think borrowing costs are too sensitive to grow your way out of this stuff. So ultimately, it is important that the Fed, if they cut, the bond market must not go up in yields like it did last September. I think that is what Powell is watching. And Powell, again, they probably are calling massive bond houses to make sure, like, hey, look, if we cut rates in September and in October and in December, or we cut in September and December, what are you guys going to do? Are you going to buy more bonds? I think that bond stability, TLT stability, the ZB stability, all these things are really important. Yields have to stay at least sideways. Okay. They can't get worse. If yields climb to new highs, I don't care how vocal Trump is, it's not a good thing. If yields drop, fine. There's your potentially a soft landing, but I think this is like you're overheating. You're overheating the economy. The market's going to melt up. Yields are down. Bonds are up. Are bonds up as well as equities? I mean, I don't know. This could be a year where all sorts of weird correlations happen. We could have, equities up, gold up, dollar up, bonds up, Bitcoin up. It's like maybe everything goes up. It's the all asset bubble type thing, right? Or we can have yields down, bonds up, equities down because bonds are up, making them more attractive. But what happens if you start pushing yields lower? It makes risk off trading of fixed income vehicles way less attractive. It forces money into the equities market. Okay. And not for a bad reason. It's just like, but if you force money in the equities market with no protection, that's a lot of risk out there that can go unchecked. So anyway, Trump is exhausting. Literally, like if anybody wants to be heard every single day and trolling, I'm glad the market doesn't take every tweet and every rant and every comment, super literal. Although we were surprised by it in April, even though he's been talking about it for 9 years. Tariffs. Okay. But I think there is a definite scramble to the trade war right now. I think there's a definite scramble to see, like, hey, is the US going to be able to prove definitively that putting on global tariffs is still going to help everybody? Is it going to help the US? Is it going to improve trade relations? Is it going to, I don't know. I think it's anti-globalization. I think it's more restrictive. I think it's certainly adding more friction to the global economy. That's not a good thing. That's not going to be helping prices. So, and I just think this summer it's like if things just kind of stay status quo and things stay relatively calm, I think there's a complacency that this market might check. It might check to see who's paying attention. Maybe that's where that 5 or 10% correction comes in. Maybe that is the August 1st deadline now, because now it got pushed, right? All right, what else do we have in this? Okay, 5 critical factors: risk of rising treasury yields, distortions, basis trade strategies, stretch valuations, tariff turbulence, VIX imbalances, blah, blah, blah. All right. Growing deficit risks and rising yields. We have seen that. 3.4 trillion budget bill into law. Tax incentives totaling 4.5 trillion represent a key component of the big beautiful bill. Temporary increase of state and local tax deduction limit from 10,000 to 40,000. Exemption on tip and overtime income, which is I think it's capped at like 25K. Expanded tax breaks for seniors and parents. $1 trillion cut to Medicaid coverage. This potentially affects like tens of millions of people. Plugging a hole in the upcoming tax revenue shortfalls. Congressional budget still predicts new budget bill to add 3.3 trillion U.S. deficits over the next decade. Introduces greater risks to holding the U.S. Treasury for investors. Global risk-free benchmark asset. That's what the U.S. bond market has been. To compensate for these adverse dynamics, heightened fiscal uncertainty, investors are likely demanding higher yields. That's why yields are rising. That's what bond vigilantes are all about. Hey, look, idiots, you want us to hold your bonds? Pay us more money. That's why yields are up, right? So the 30-year elevated near 5%. Okay. So it's not nothing. Bond market is smart. And I'm telling you, like, it'll tell the markets what to do. Let's see here. This is a good article. The gilt crisis in September 2022. We saw that was the Liz Truss moment. That's what they're comparing this basis rate to that happened in April. So anyway, I'll go through this article. We'll summarize it. And stress valuations leave no margin for error. I agree. I mean, we've got Mag 7 earnings still like price to earnings at like 29 or 30. We've got S&P overall PE around 24, 25 now. It's a high premium. So I just think that earnings have to be stellar. They really do. And look, they can be fudged. You know, it's like you can comment AI and say everything's looking good and how the future is bright and rosy, and maybe the market takes it up. But if that's not everybody's tone, then maybe it changes. All right. Anyway, pretty thorough stuff. Tariff turbulence. We still have an ongoing Middle East, geopolitical crisis going on, or tensions. VIX signals growing unease. Let me take a look at VIX term structure. VIX term structure. Are we doing backwardation or contango? Right now we're in contango. So far so good. Going out further in time, higher VIX versus near term is more uncertain. So there's at least contango on the VIX term structure. Pin to elevated levels. Pin behavior. It's definitely vol suppressing. That's what it feels like. July could mark a critical junction for markets as potential for rising treasury yields and tariff-related alterations to existing cost structures threaten to compress valuations. Basis trade to risk upending broader microdynamics. Destabilize the equity market, coupled with growing unease amongst investors observed through elevated VIX, which we have yet to really see. It's still at 16 and change, 17. Elevated but not broken. Like, we're not greater than 20. We don't have like high VIX environments right now, or moderate VIX environments. We do have current all-time high valuations though, and we haven't seen a de-risking because the market seems like, hey, we're going to grow through this. We're going to grow our way out of it. So yeah, I mean, end of the day, it's just caution. Caution has some protection just in case. That's probably going to be the best plan for 2025 is protection just in case. Just in case. So, all right. I'll let you go for today's final hour. Thanks for being with us. And crazy quiet day. Crazy quiet day. Tomorrow, 2 p.m. FOMC. Does the market take any note from directions? We had a super choppy day today. Perfect daily profit play. We grabbed a nice winner out of that. What's your P&L in the first 6 months? I don't know. I mean, 2024 was way more bullish to this point versus, I mean, right now I'm up around 20%, just over 20% for 2025 after kind of surviving March and April. I had about a 6% drawdown and ended up, I'm up about 20+% for the account. But P&L last year, it's like April was the only hiccup that we really had. We had a dip in April, a dip in August. I bought through both of those, and last year finished nearly 40%. So I don't know. I mean, I think that just through the year, last year was a lot more steady, a lot more bullish on every dip. This one we're clearly at all-time highs after a really reflexive move off the April lows. I just don't know how much more upside momentum there's going to be for 2025. I mean, S&P's up around 6% for the year, 7% for the year. Do we just kind of hang out there? History shows if you have 20+% years, you typically get a third one that trickles into like the 8, 9, 10% zone. With this tax bill and kind of a boon for stocks, maybe there is no alternative, and the best place to be is stocks, maybe. So maybe we have another like freakishly good year at 10, 12, 15%. If that's the case, I'll probably finish the year closer to 30% gains. But a lot more of a 20% correction is no joke. I thought we had like a systemic global trade war going on, so that was definitely more about protection. And then we come out of it. But I don't know, Mark, or I'm sorry, William. To me, the trading 2024 was a lot easier. Trading 2023 was a lot easier. 2022 was timing that market in Q4. That was pretty easy. This year's been a lot of question marks on, how high can we go? How low can we go? Where's the correction? How, the analysts like all-time highs to lows. I mean, the predictions are all over the place. Literally over the weekend, somebody's talking about a 7,000 S&P. In the same breath, somebody's talking about a 4,500 S&P. That's a huge disparity, right? So anyway, we just keep grinding, man. Just keep doing our best. And like I said, best thing to do is have protection. If you'll be thankful if you need it. If you don't, you shave off a couple percent, but you still fight the good fight, and you win the day, you win the year, whatever it takes. That's definitely the philosophy. So, all right, I'll let you go. Have a good rest of the day. Come back and see me tomorrow. All right, thanks. Bye.